Pop quiz. In spring 2020, Canada's National Housing Agency predicted home prices would crash 9% to 18%. What actually happened? Well, prices went up 40% in some markets over the next 18 months. In 2022, one of Canada's biggest banks said prices would fall 20 to 25%. The actual drop was about 15%, and it was over in about 8 months. So when CMHC, RBC, TD, and CREA released their 2026 forecasts, and yes, they're all saying different things, the question isn't who's right. The question is, why does everyone keep getting this wrong? And what are they missing this time? I'm going to show you the 2026 predictions, then I'm going to grade them against what the same institutions said in 2020, in 2022, 2023, and 2024. And then, here's the part that matters. If you're actually trying to time a purchase or sale, I'm going to show you the supply side math that almost nobody talks about. Housing starts collapsing, condo cancellations at record highs, and a pipeline that's running dry while demand is not. Here's the dirty secret about real estate forecasting. It's not designed to be accurate. These forecasts from the banks and government agencies, they're not crystal balls. They're risk management tools. They help institutions set lending policies, budget for insurance claims, and justify policy decisions to politicians. But here's what makes them almost impossible to get right. They assume linear behavior. People don't behave linearly when interest rates swing 400 basis points. They can't predict policy changes. So things like immigration targets, zoning reforms, emergency rate cuts. They're also backwards looking, so they smooth out volatility that already happened. And they're consensus driven. Nobody wants to be the only one who's wildly wrong. Think about it. The CMHC in 2020 couldn't predict that the government would unleash CERB, drop rates to near zero, and accidentally create the biggest housing boom in Canadian history. TD in 2022 couldn't predict that even after the fastest rate hikes in decades, employment would stay strong, immigration would stay high, and price declines would be shallow and short. So when you hear 2026 predictions, what you're really hearing is, here's what happens if nothing unexpected happens. And when does nothing unexpected happen in Canadian real estate? Okay, let's get into it. So what are the big four actually saying about 2026? And more importantly, where do they disagree? CMHC's February 2025 outlook is basically the institutional version of they're calling for slow price growth and modest sales increases in 2026, with recovery being uneven across regions. Here's the key phrase they keep using: codependent markets will lag. And what does that mean in English? Toronto, they're talking about Toronto. Specifically, they're saying if you're sitting on a pre-construction condo assignment or an investor-owned unit downtown, you're in the weakest part of the market. But here's what's interesting. CMHC also says the single-family market, especially in suburbs and smaller Ontario cities, could see stronger demand as buyers priced out of Toronto look elsewhere. So the prediction, not a crash, not a boom, a two-speed market where detached homes in secondary cities do okay and downtown condos stay soft. RBC is more bearish, okay, especially on Ontario. Their most recent housing forecast update warns that Ontario and BC could see the steepest price declines in 2026, driven by elevated inventory, weak competition among buyers. They're specifically calling for a national price dip, meaning even as other regions recover, Ontario is going to drag the average down. So why? 3 reasons. Inventory still elevated, especially in the condo segment. Investor demand is dead with negative cash flow on most rental properties. The speculative bid is gone. Affordability is still broken. Even after price corrections, the payment to income ratio in the GTA it's worse than it was even in 2017. The prediction, RBC is essentially saying sales might go up as people capitulate and accept lower prices, but don't confuse activity with price growth. They're expecting flat to slightly negative price movement in Ontario through 2026. TD Economics is somewhere in the middle. Their provincial outlook calls for gradual, modest recovery nationally in 2026, and this is the kicker, they explicitly flag Ontario as one of the weakest regions coming out of 2025's sluggish performance. TD is basically saying the housing market will get better in 2026, just not in Ontario first. So why? Same structural issues, too much condo supply, too little single family supply, and an economy that's more sensitive to rate changes because, let's face it, household debt in Ontario is higher than almost anywhere else in the country. So their prediction, Sales up modestly, prices flat, slightly up nationally, but Ontario lags, meaning while Calgary and Halifax might see as much as 5 to 8% price gains, Toronto might see like 0 to 2%. And then there's CREA, the Canadian Real Estate Association, which represents agents and brokerages. And their January 2026 update, which they just revised down because of the tariff uncertainty, still calls for sales growth of around 5% nationally in 2026. CREA tends to be the most optimistic of the bunch, and to be fair, they're often right about sales volume bouncing back. Their 2026 forecast shows recovery room, specifically in BC and Ontario, as pent-up demand re-enters the market. But here's the nuance. CREA is predicting sales growth, not necessarily price growth. More transactions doesn't mean higher prices. It can just mean more people accepting reality and transacting at lower levels. So the prediction, activity picks up, prices stabilize or grow modestly, but the real recovery is in 2027 to 2028, not 2026. So to recap, CMHC says slow and uneven. RBC says Ontario is in trouble. TD says recovery, but Ontario's last, and CREA says sales bounce back. Who's right? Well, let's check their report cards from the last few years and see. This is my favorite part, because if you really want to know whether to trust 2026 forecasts, you need to see what these same institutions said in 2020, 22, 23, and 2024, and compare it to what actually happened. In June 2020, CMHC released a special edition of their Housing Market Outlook. The title, Housing Market Outlook Special Edition, and they forecasted that average MLS prices could fall 9 to 18% from pre-COVID levels, depending on the scenario. They warned of a prolonged housing downturn lasting into 2021. We all know what actually happened. Prices went up nationally, like average prices rose about 17% in 2020, and then another 20% in 2021. In the GTA, detached homes went up over 30% in some suburban pockets. Now, to be fair to CMHC, in March and April 2020, sales did crater, but they recovered by June. And the government dropped rates to 0.25%, launched CERB, and created the biggest liquidity event, I think, in Canadian history. So the lesson, CMHC couldn't predict the policy response, nobody could, but it's a reminder that forecasts are only as good as the assumptions, and when assumptions break, forecasts become fiction. Fast forward to 2022, interest rates are rising faster than they have since the 90s, the market is cooling, and TD Economics releases a report titled Canadian Housing Outlook, Testing the Foundation. And their forecast, prices could fall 20 to 25%, peak to trough, and sales would collapse. What actually happened? CMHC later reported that prices fell about 14 to 15% nationally from the February 2022 peak to the bottom in early 2023. And by mid-2023, prices were already stabilizing. So TD wasn't wrong about direction, prices did fall, but they overshot the magnitude by almost 50%. Why? Because they underestimated how sticky housing demand is in Canada. Immigration stayed high, household formation kept growing, listings didn't flood the market because most people who bought in 2020 and 2021 had locked in these low rates and they just weren't forced to sell. So the lesson there, forecasts often overestimate volatility because they assume rational behavior, but housing is where people live. It's not just an investment. So people don't sell their homes in a panic the way that they would in the stock market. In 2023 and 2024, all of the major forecasters started saying the same thing, gradual recovery ahead. RBC, TD, CMHC, they all predicted that by mid to late 2024, we'd see sales picking up and prices stabilizing and modestly rising. And they were sort of right. Sales did stabilize, prices did stop falling, but the recovery really stalled. We didn't get the momentum near to what they expected. And why is that? Well, I think two things. Rates stayed higher for longer than anyone predicted in 2023, and the psychology shifted. After 18 months of bad headlines about falling prices, buyers just got comfortable waiting it out. So the lesson there is forecasts struggle with timing. They're decent at saying the market will recover eventually, but they're terrible at saying when. So here's a bit of a pattern. Forecasters miss turning points. They overshoot the magnitude and they underestimate policy responses and behavioral stickiness. Which means when you hear 2026 forecasts, you shouldn't ask, is this true? You should ask, what would have to happen for this to be wrong? And that brings us to the thing that almost nobody's talking about, supply. Here's the thing about real estate forecasts. They're obsessed with demand, rates, immigration, buyer sentiment, affordability, all valid things to focus on, but the supply side of the equation, that's where the next crisis is quietly building, and it's the thing that could make all of these 2026 forecasts irrelevant by 2027 or 2028. So let's start with housing starts, the number of new homes where construction actually begins. CMHC just reported that 2025 housing starts totaled about 259,000 nationally, so up 5.6% from 2024. Sounds great, right? Except Ontario is a different story. So Ontario starts in 2025 around 62,000. That's down significantly from prior years. And here's where it gets spicy. Ontario's government now has a target to ramp up to approximately 175,000 starts per year from 2026 onward to meet their broader housing goals. Let me say that again. Ontario built around 62,000 homes in 2025. Their target for 2026, 175,000. That's not a gap. That's a canyon. That's almost 3 times amount what they've done. That's a 3 times increase needed in a single year. And here's the problem. You don't just flip a switch and triple housing starts. You need land, approvals, financing, labor, materials, all of which are seriously constrained right now. So what does this mean for 2026 and beyond? It means that even if demand stays soft in 2026, even if prices drift sideways or down slightly, the supply shortage is getting worse. It's not getting better. And when supply lags demand for long enough, eventually the price mechanism kicks in. And we saw this play out in the US after 2008. So housing starts collapsed during the financial crisis, and by 2012, 2013, even though demand was still very weak, supply was so constrained that prices started rising before the demand ever fully recovered. Now, let's zoom into the GTA condo market, because this is where the supply story gets really interesting. Urban Nation, the condo market research firm, just released their 2025 year-end data, and it's not pretty, okay? 2025 saw a record 28 active projects canceled, totaling 7,200. Condo construction starts almost completely collapsed to just 3,200 units, the lowest level since the 1990s. And the total inventory of condos under construction fell to 50,000 units. That's a 10-year low. Now, some of these canceled projects didn't die completely, some converted to purpose-built rentals, but the key point is the condo pipeline is shutting down. It could not be more clear, and here's why this matters. And this is the part that takes 2 to 3 years to show up, so nobody's really panicking yet. A condo takes 3 to 5 years from groundbreaking to completion. These condos completing in 2026 and 2027, those all started in 2022 and 2023 when the market was still piping hot. But the condos completing in 2028, 29, 2030, these should be starting now, and they're just not. So we're going to have this weird completion wave in 26 and 2027 as the pre-2023 projects finish off, which will keep inventory elevated and prices soft in the short term. But until then, completions fall off a cliff. Urban Nation is already predicting that after the 2025-26 wave, completions drop significantly because construction has collapsed. And here's the kicker. Toronto's population, it's still growing. Immigration might be down from the peak, but it's definitely not zero. International students are still coming. Household formation is still happening. So what happens when you have steady or growing demand and a shrinking supply pipeline? Eventually, probably late 2027, early 2028, the rental market tightens first. Rents go up. Investors who left the market in 2023 and 24, they start coming back, and then slowly resale prices start to follow. And this is a cycle almost nobody's talking about because it's not happening today, but it's being set up right now. Okay, if I had to make a prediction for 2026, not based on blind optimism or pessimism, but based on what the data is actually saying, here's what I would say. On sales, I think CREA hit the nail on the head. Sales are going to be a little bit higher in 2026 compared to 2025, maybe up 3 to 7% across Canada, 4 to 6% in Ontario. I think all this pent-up demand, people are tired of waiting on the sidelines. Rates have been stable for long enough, and this lines up with what most of the consensus forecasts. On prices for Ontario, I think RBC and TD are probably right that Ontario will be one of the weaker markets. I'd expect prices to be flat to modestly down the GTA, especially in the condo segment. Maybe something like 2 to 4% on average, with pockets of downtown Toronto down even more and suburbs maybe holding a little bit steadier. Single family homes in secondary cities like Hamilton, Burlington, Kitchener, these probably hold up better or even see modest gains as buyers look for better relative value. On supply, this is where I diverge from the consensus. I think most forecasts are underweighting the supply collapse, the housing starts gap, the condo cancellations, the drying pipeline. This is setting up a 2027, 2028 supply shock that almost nobody's pricing in yet. CMHC has said that restoring affordability in Canada requires millions of additional units by 2030. But Ontario and BC, making up like 60% of the shortfall, we're not even close to building at that pace. We're moving in the opposite direction. So here's my actual prediction. 2026 is a transition year. It's not the bottom, it's not the recovery. It's the year where the market finds a floor on demand and where the supply side quietly implodes. And if I'm right, the people who buy in 2026, especially single family homes in high growth secondary markets and condos in well-located buildings with strong fundamentals and figures, they're going to look really, really smart in 2028. So remember that pop quiz from the beginning, the forecasters who got 2020 and 2022 wrong? Look, they weren't stupid. They just didn't know what they didn't know. And neither do I, and neither does anybody. But here's what I do know. Forecasts are not crystal balls. I would think of them more like flashlights. They help you see the range of possible outcomes. They help you definitely ask better questions. And the best question you can ask right now isn't will prices go up or down in 2026? The best question is what's happening to supply and what does that mean for 2027, 28, and 2029? Because that's where the next cycle gets built or canceled. If you want me to go deeper on this, local market breakdowns for Hamilton, Burlington, Oakville, Toronto, submarkets, inventory analysis, let me know in the comments. I'll make a part 2. And if you made it this far, thank you for watching. Hit subscribe if you want more of this kind of thing.